You find a house, you put the price into a mortgage calculator on your phone, and it gives you a number. $2,000 a month. That feels doable. You start planning around it. Then you actually buy the house, and the payment is closer to $3,000. Nothing went wrong. The calculator wasn't broken, and nobody lied to you. It just showed you the part of the payment that goes to the house, and quietly left out the part that doesn't. In some American cities, that missing part is almost half the bill. Here's where it's worst, why it happens, and how to find your real number before you fall in love with a house you can't afford. Chapter 1. What's actually in the payment? Your monthly payment is 4 things wearing one number. Lenders call it PITI, which is just the first letters. Principal, that's you buying a slice of the house every month. Interest, that's the bank's fee for lending you the money. Those 2 are what your calculator showed you. Then, taxes, your county's property tax divided into 12. And insurance, the policy your lender requires before they'll hand over a cent. You don't pay those separately. Your lender collects them inside your monthly payment, holds them in an account, and pays the bills for you. So they're not a side cost you can budget for later, they are the payment. Which raises an obvious question. How much are we actually talking about? Chapter 2. How big the missing part is. Across about 450 American metro areas, taxes and insurance make up an average of 21% of the monthly mortgage payment, $1 in 5. On that $2,000 payment you were planning around, roughly $400 of it was never going to touch the house. That's the average. Averages are where this channel usually finds the interesting part, and this is no exception. In Pensacola, Florida, taxes and insurance are 43.6% of the payment. Principal and interest come to $1,531. Taxes and insurance add another $1,183. $2,700 a month, and almost half of it is doing nothing to pay down the house. Decatur, Illinois is at 37%, Messina, New York 36.5%, Miami 34%, where the split is $2,400 to the house and $1,200 to everything else. 5 of the 10 worst metros in the country are in Florida and Illinois. And here's the part I did not expect. They're on that list for completely opposite reasons. Chapter 3. 2 different problems, 1 symptom. In the Illinois metros, home prices are ordinary, nothing dramatic. The problem is the property tax rate sitting on top of them. We covered why in the property tax video. Local government and schools are funded from the property bill, and Illinois has a lot of both. The house is affordable, the bill attached to it isn't. Florida is the other story entirely. Property taxes there aren't the problem. Insurance is. Hurricane and flood risk have pushed premiums up hard, and nationally, the average homeowners premium rose more than 10% between the last 2 reporting years alone. When insurers price a coastline, that price lands in your monthly payment. So 2 families in 2 states can have the same painful payment for reasons that have nothing to do with each other. One is paying for schools, one is paying for weather. Which tells you something useful. This isn't one problem, it's 2, and they need different questions. Chapter 4. The part that surprised me. If you had asked me to guess where the hidden costs are worst, I'd have said the expensive cities. Big house, big taxes, big insurance. That seems obvious. Honolulu has the lowest share in the entire country, 9%. In one of the most expensive housing markets in America. The reason is something we found in an earlier video. Hawaii has the lowest effective property tax rate in the country, and its insurance market has stayed relatively stable. So Honolulu buyers face an enormous price and a huge monthly payment. But almost all of it is actually buying the house. That's worth sitting with, because it breaks the assumption. How expensive a city is, and how much of your payment disappears into taxes and insurance, are 2 completely separate things. A cheap city can have a terrible ratio, an expensive one can have a clean one. Other metros with low hidden costs: St. George in Utah, Grand Junction in Colorado, Provo, Flagstaff. So you can't guess this from the price tag. You have to look it up. Which brings us to what this actually does to your budget. Chapter 5. What it does to what you can afford. Here's why this matters more than it sounds. Lenders don't approve you on the mortgage. They approve you on the whole payment. So every dollar of property tax and insurance is a dollar of borrowing power gone. In a high-tax county, the tax bill alone can eat the room you needed to qualify for the house you wanted. 2 identical houses, 2 counties, same buyer, same salary. 1 approval, 1 rejection. Nothing about the buyer changed, and this is on top of an affordability problem that's already severe. Nationally, you now need about $107,000 a year to afford the median home. The median household earns about $84,000. That's a gap of over $20,000 before we even talk about which county you're buying in. There's one more lever worth knowing about. How much you put down changes the required income sharply. Putting 5% down instead of 20% means you need roughly $22,000 more in annual income for the same house, because you're borrowing more and you're paying mortgage insurance on top. So the question isn't really, can you afford this house? It's, can you afford this house in this county with this insurance market? Chapter 6. The part you can use. 3 things, and you can do all of them this week. 1. Stop using the calculator that only shows principal and interest. Before you get attached to a house, get a real PITI quote, the full payment with taxes and insurance in it for that specific address. Any lender will produce one. Most people never ask until they're already emotionally committed. 2. Look up the property tax for the county, not the state. State figures are averages, and we showed in the property tax video that rates inside a single state can differ by 10 times. Your county assessor publishes the real rate, usually on a website that looks like it was built in 2004. 3. Get an insurance quote before you make an offer, not after. In Florida, coastal Texas, parts of Louisiana, and increasingly California, this is the number that surprises people. It is also the only one of the 4 you can shop around for, so it's the one place you have real leverage. The house has a price. That price tells you what you'll borrow. It does not tell you what you'll pay, and in about 1 American metro in 10, the difference is enormous. Look up the county, get the insurance quote, ask for the whole payment. Next time, what childcare actually costs, state by state. In most of the country, it now beats a year of in-state college tuition, and almost nobody plans for it.